Well, it's been just about the most bullish market in recent history. In fact, it's been the most bullish 8 days for US shares of the last 20 years. So, hi there, everyone. Welcome to the Trader Circle Weekly Market Update. Today is Tuesday, the 20th of August, 2024. And before I get started, you do need to be aware that whatever I say is general advice only, and it does not consider your personal financial circumstances. You have to decide whether it's appropriate for you. So, the first thing I wanted to talk about is the recovery, emphasis on the V because it has been V-shaped. At the start of August, we saw pretty strong selling. US markets corrected. Our own market almost got that technical correction. Didn't quite get the 10% fall. I think we ended up around 8.5 to 9% from top to bottom. It was a very, very large fall, and it came obviously on the back of the Bank of Japan lifting interest rates and then weaker than expected US jobs data. That jobs data basically caused a big rout in US government bond yields. Bond yields fell off right at the same time that that Japanese bonds were lifting in yield due to the rate rise. Now that divergence between US and Japanese yields caused a big unwinding of a massive sort of carry trade. A lot of people had been borrowing in yen and lending in US dollars, and that trade got unwound quite rapidly, and that led to massive selling across most financial markets, particularly equity markets, obviously. Since then, and over the past 2 weeks, we've seen a ridiculous rebound, really quite an unbelievably strong rebound in shares around the world. It's been quite breathtaking. It's still going, obviously. It's been quite breathtaking, just the pace and strength of that rebound. I did want to touch on this, and I just want to say that these volatile, very large, rapid, and strong movements, there haven't been the hallmarks of long, stable bull markets of history. If anything, this is the sort of rapid fluctuation that we tend to see, uh, maybe not at crisis points, but at times where markets are undergoing extreme volatility. And these tend to be when markets are selling or before markets sell down. And I'm not going to necessarily say that's the case this time around, but I do think that it's not a solid foundation for which to build a continued bull rally. I could be completely wrong, but I don't think it really bodes well for stable, continuous, uninterrupted gains moving into 2025, 2026. And just on that, obviously the big bullish driver for markets this year has been the Federal Reserve expected rate cut. And the market's almost certain, and it is almost certain, almost guaranteed that the Fed will cut rates in September next month. They will have their policy symposium at Jackson Hole this week, and we will get speeches from Fed members over the next few days, and they're almost guaranteed to confirm that rate cuts will come next month as well. While that has been a bit of a bullish carrot dangling in front of markets, historically it actually hasn't been a bullish thing. In fact, when rate cuts come is typically when we see markets start selling down. And we've sort of built quite an elevated platform for markets to potentially sell down from. I think I read that the average 6-month return for US markets following the first rate cut is about negative 23%. And, that does seem like an extreme sell down, but like I said, we've built up such an elevated platform. Prices are extremely expensive and valuations are so high that a 23% sell down isn't impossible. So that is the sort of story with US shares and with the US central bank. Our central bank is a little bit different. We're not expected to cut rates this year. At least the RBA has not indicated they would cut rates this year. And indeed, today we saw the release of the monetary policy meeting minutes for the RBA from their August meeting, and they remained fairly hawkish. To be honest, they sort of said that inflation was too high. Um, we need to do more to bring inflation down in Australia, and they don't want to risk inflation getting out of control. Inflation hasn't fallen in Australia for a few months now, really. And if you're looking at just Australia by itself, you'd have to say that a rate rise looks more likely than a rate cut for Australia. Now, obviously, if central banks around the world are cutting, and we've seen market volatility, and people are nervous of sort of a big economic crash globally, it makes it less likely for the RBA to raise rates again. But I do just want to sort of highlight that we are in a bit of a divergent path. with the RBA and the US Federal Reserve. And, you can't rely on our RBA to basically follow the lead of the Federal Reserve unless obviously Australian data starts to deteriorate. All right, finally, I wanted to touch on earnings. We're in the middle of the August company earnings reporting season, the biggest one of the year, and so far it's been pretty underwhelming, to be honest. Obviously, our market is significantly higher in price this year than last year. That's been led by, obviously, the US equity strength, US share market strength. But if you look at our companies by themselves, they're actually not doing much better than last year. On average, earnings are expected to be lower this year than last year, despite our prices being around 10% higher. We saw CBA report earnings. Earnings were down, I think, roughly 5% year on year, despite, again, its share price being 20 to 30% higher. Large iron ore miners, their earnings are likely to be lower this year and indeed in the next half year as well, due to the weak iron ore prices. And many parts of our market are actually reporting a decline in earnings this year on last year. The earnings haven't been enough to sort of turn our market lower. I think our market, at least for the time being, is happy to follow the US lead. If they rise, we'll rise, and if they see selling, we'll see selling as well. However, there's only so much our shares can do, only so much their prices can rise without, an equivalent earnings growth to sort of back that up. Because in the absence of that earnings growth, our shares are just becoming, more and more and more expensive from a valuation perspective. And the heavy lifters of our market are some of the most expensive shares in their sectors on earth. And eventually, that builds up a potential sort of big floor to the downside, big gap to the downside should they turn around from their uptrends. So I do think there's a lot of risk to the downside. There might be incremental gains to the upside as well, but when markets do turn, and like we saw at the start of August, a lot of value can be lost very, very quickly in the current environment. So let's have a quick look at the charts for this week, guys. We'll have a look at the S&P 500, and this is the V I was talking about. From the start of August, they had 3 days of extremely strong selling. That took them to a correction or more than 10% move from their peak. And since then, they've been on a pretty ridiculous bullish run. In fact, last night, they actually recovered all of their August losses. And indeed, they showed a bullish candlestick up towards the all-time high at 56.70. There's every chance they reach those levels this week. What I'd be looking for is if they're unable to exceed those levels. If we see a double top or a lower peak, and to me that would be quite a bearish sign for the overall trend of the index. If they do exceed that though, you would expect further upwards movement. And indeed, as I mentioned previously, it's likely that things will remain fairly positive, at least until we see the first rate cuts. Once the rate cuts start coming through, the market's attention starts to turn towards more negative things, a potential economic downturn, potential deterioration of data, a drop in company earnings. But for now, that carrot's remaining, dangling in front of the market. That rate cut is tantalizingly close, but it's probably best for the market if it never comes, to be honest. If we have a look at the Australian market, the XJO, we can basically see that we've also sort of recovered quite strongly from our August selling, and we've rebounded a fair bit over the past 2 weeks as well. We bounced off that support level, 76.50, pretty key level for the year, and we've returned to the 8,000 point level. We didn't have the strength to go through it today. We tried to, we pulled back underneath it, and I think we've decided to wait to see what US markets do tonight. Should they close higher, should we see a positive gain tomorrow, we're then looking towards previous peaks, 80.70, 81.30, 81.20 roughly. I think it's going to be hard for our market to go far beyond those levels, if at all, especially when iron ore miners are struggling, especially when the banks are seriously overbought, and especially with a large amount of dividends coming out of our market over the next 2 weeks. So I do think that a peak is nearby. It might be a little bit higher, but I would expect to turn around at some point soon. So we'll wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click subscribe. If you did, please subscribe to our channel. It would really help us out a lot. And hopefully I'll see you guys in the next video as well. Bye for now.